Hello, everyone, and welcome to the third episode of Wine and Markets with Dan and Cam. My name is Daniel, and I'm here with Cameron. Just to get out of the way, just a little bit more of the general advice, sort of disclaimer of sorts. So anything you hear today is general advice and general in nature. Nothing we are saying here today takes into account your personal circumstances or finances. If you need assistance, we highly encourage you to seek a financial advisor. Great, so now that's out of the way. What we'll be covering today is some dessert options, given it is winter here in Australia.
So just out of it, but today feels like it.
It does feel like it, and I think what a fitting thing to just sort of cover maybe two wines, a red and a white, that probably will be great in front of a fire.
I think so, yeah. Definitely something to just, if you've got time to just relax and enjoy, absolutely. Mm-hmm. So I'll start with mine. So technically this is like, it's called a vin jaune in France from the Jura. But what this is made by, it's a grape I suspect most people won't have tried before, called Savagnin. And this is actually out of the Mornington Peninsula in Victoria and by Crittenden estate actually. And so the quirky thing for this wine is it's made with partial oxidization. So they actually put the wine in these barrels. They don't disturb it, but there's also protective yeast that helps protect the wine from excessively oxidizing. Because if wine gets too much oxygen, well, you've got a whole barrel full of vinegar. It's good, but not for actual drinking purposes. But yeah, so anyway, this wine, what to expect from it? It's bloody rich flavors. It's like nutty, a bit salty as well, and very syrupy, like viscous.
It's strong.
Well. Yeah,
it's got a very strong nose.
And we're kind of debating what you'd actually enjoy this with, and we're thinking sort of cheeses, but particularly if you like cheeses on the stronger flavor side, I think this would be a really nice pairing because it's bone dry. Like unlike your ports and your Tawnys where you get quite a bit of residual sugar, you don't get that with this experience. So it's one thing we can both agree on. It's very indulgent.
And the cheese that you chose.
Yeah, so the recommendation for this was Comte, which I think it's a lovely cheese, and the one I got from this place in Dulwich Hill, Larder Wine and Cheese Bar, I think it's called. Definitely a neat place if you're in and around the inner west. But I think it's a lovely cheese. I'm not sure if it's quite strong enough, and so.
Yeah, so having looked at different, I think I went overboard on the amount of cheeses I got for today, given we've got friends and whatnot coming later that will probably be enjoying this. But in saying that, having tried it with, now, Comte is a great cheese, and even with other sort of maybe other dessert wines that are sweeter in flavour, will probably give you, with a little bit more of the crust at the end, will give you that honey sort of that coming out of that, which is really a weird sort of taste. However, with this one, I thought, given we've got all these cheeses here, I think we needed something a little bit stronger, maybe a blue cheese, and the blue cheese, I think we just got a Danish blue, was pretty good. Yeah. With a little bit of Quince paste, actually made it taste quite amazing.
You've got a really strong flavour with this wine, so you need something to match up to it as well. Yeah. And I do agree. Like I probably like Comte more than blue cheese in terms of personal preference, but in terms of what would go with this, absolutely. And I should have said before, vin jaune, it literally means yellow wine, and you can kind of see on the camera.
It's quite yellow.
Yeah, but and very different.
And to have it with a baguette, they say,
yes,
as instead of a cracker.
A suggestion. Yes.
And I hardly agree, but I think the blue cheese with the quince and the baguette, the way to go. That was fantastic.
But I do say, like, in terms of personal preferences, like I got this as a bit of a curio, like something to try. Yep. And we're having this debate. Like, I think I would have something like this again, but it'd have to be with the right crowd of people. I think it's not something you'd want to, unless you really fell in love with this kind of style. And like maybe the traditional French ones are even better and stuff. And I have had one or two others that are decent expressions, but they get quite pricey. Just because the way this is made, you lose so much wine just to time and evaporation as well. But in terms of I might have another one stashed away somewhere, but it's probably not a style I necessarily, reach out to. I don't know. What do you think, Clay?
I think you'd probably have to take your time with this. Like even with this glass, I'm really taking my time with, and at first it's a bit of a struggle until I guess we paired it with the right cheese and whatnot. But you'd need to have it. You can't. I wouldn't have it on its own. I would have it with something.
It is changing though. So the one thing in its defense might be, it probably, if you're going to have it at, I say young age of 6 years, like you might actually want to throw it into a decanter, which is unusual for white wine. But with this one, because you've got the excess alcohol as well, like I think a decanter would definitely help open it up. And there's probably a pretty good chance we have it later tonight and it's actually sort of turned into something really different. So, but wait and see.
Yeah, wait and see for sure. Now, I guess moving on from the wine sort of segment of things onto, I guess, some of the topics of what we might be covering today.
Oh, did you want to introduce them?
We'll probably do that a little bit later. And topics: China. Mortgage interest rates, where to set, I guess, a lot of those conversations around, interest rates, where are we doing fixed or variable? There's those types of discussions given where things are at. Maybe a little bit of an update on inflation, something that we really wanted to cover over this this session. So shall we start with China?
Yeah. What about China? Like, it's been a great place to invest the last year, hasn't it?
Well,
just emerging markets in general. For context, they've actually been a terrible place to invest in. You've probably underperformed if you had a materially overweight.
Yeah, recently. I guess the question that keeps on being asked at conferences, the question that keeps on getting asked around tables, around researchers and other investment professionals has been, if we get a scenario where sanctions are put on the country, should we be looking? Obviously, that's a risk in a portfolio. What do you do? Should you be exiting China now, given that there's no real changes geopolitically? These questions, I guess, are questions that are being asked. It's questions that we wanted to sort of explore a little bit on. My viewpoint has been, well, I'll call it out. It's, you can't make moves like that because geopolitically anything can happen. So again, if there are sort of governmental sort of sanctions on, obviously you follow the law and that's the end of it, and you do what you need to do when the time does arrive. We'll cross that bridge when we get to it, but until then it's just looking at the fundamentals and looking at what I guess overall markets and what you have exposures to, because at the end of the day China makes up 50% of the emerging market index, and it's not having it is taking a bet against it. And do you want to, given that there's probably quite a bit of stimulus being pumped into their domestic markets right now? But again, I do realise there's also some weakness with COVID zero. There's weaknesses in terms of them, mortgage, the real estate sort of environment there is looking a bit shaky. Potentially some of the finance sector. I don't know. That's how I'm sort of in a nutshell thinking about it.
I think investing in any emerging market, which I'd still firmly put China into that category, can be difficult. Even if you're just investing in a broad sort of emerging markets like ETF or fund, it's probably not been a fun time. Even though some countries like Brazil's had a great year.
Correct.
Because they've got a overexposure to sort of like energy and commodities. That it's been one of the better performing indices actually in global markets. In terms of investing in China, what to do, I think, I think I always try and bring it back to basics. It's like, what sort of yield do I expect to get? What do I expect to still get strong growth out of there?
Yep.
Do I expect to actually be looked after as a shareholder? Now, that's the part where I'm kind of a bit iffy. And that's one of the risks with emerging markets in general. They tend to see more government actions that aren't shareholder friendly. So whether that's like new taxes or new policies, like this common prosperity stuff in China, which basically turned into a big tax on some of the major tech companies there. So is that a risk you're willing to take? I think, look, there's a price for anything.
And the risk does give you some type of reward as well, if taken
at the right price. At the right price is the thing. Look, and honestly, I think it's hard. I think it's an investor. Every individual, every institution is having to make for themselves, and you're definitely seeing people place their bets, so to speak, in that regard. And I think people are wanting China exposure on this promise of growth. But I think the other thing we should bear in mind, and I've ummed and ahed on this for a while, because I get the allure, like you see these giants like Alibaba and Tencent and how well they've done. But then you also look at just how badly investing in that market has been outside of certain periods. And to be honest, it's a really tough question. And like, what do I do for myself? Like, I used to allocate directly to EM. I actually don't anymore. I allocate to managers that are able to allocate to EM in more of an opportunistic fashion. And I think ultimately that's the one I've come and made my peace with, so to speak. Just because, while I think there is scope for EM markets to outperform and stuff, I just think it's a tough area, and it's easy to really screw it up as well. Like, and we've seen that. So some of these fund managers that are available to like retail investors have just had, they might have had a good long-term track record, but their recent one has just been absolutely diabolical.
And some of the long-term, they've managed to avoid risks that we've sort of seen in markets. They've managed to avoid risks around, overall volatility compared to the benchmark has been much, much lower. Now, this period has been very much of an eye-opening experience.
Yeah. When we say volatility, we mean just like risk. So it's general. Like the amount your share prices fall, and
it's
the general volatility.
I guess it's the movement between price fluctuations, and that's the risk that's sort of factored in over the benchmark. So that's volatility.
Yeah.
Sorry, I should have explained that.
No, that's all right.
But yeah, it's that pretty much. I'm still a big believer that you can't just avoid a whole asset class like that. I think it is an asset class that probably needs to be in a diversified sense of a portfolio. I think it's really important. And I know, talking geopolitically, talking sanctions, you can't really just say, no, I'm not going to invest in, I'm going to exit based on a future scenario that potentially might not even occur. We don't know. The thing is, we just don't know.
Yeah.
And until then, I guess the only decision as investors we should be looking at is saying, okay, well, let's look at the overall risk. Let's look at the fundamentals, and maybe choose a manager that can maneuver where they can within emerging markets. So I wouldn't say it as part of I would actually give an actual discrete allocation. And I'd be happy to say, well, it is a discrete allocation. It is much smaller of my portfolio, smaller part of my portfolio, and I'm happy for it to be the sort of alpha generator when it needs to be. And then when things are a little bit more tough, maybe you move a little bit more dynamically. I don't know. That's how I'm sort of seeing that whole conversation. I think it's, until we get to a period where it's like a Russia-Ukraine sort of situation, where we'll take steps once we get to that stage. But until we get to that stage, I think it's you just don't know what can happen, and especially with autocrats, especially with some of the governments that we see around the world in emerging markets. You just don't know how they'll move and how they'll react, and it could be very sudden and very quickly. So that's just my view.
No, and the other thing to note is, like, even if you avoid investing in places like China and Brazil directly, if you have international shares exposure, whether it's in your personal account or your super, like, you're going to have exposure ultimately to these markets anyway, just from revenue. Like, look at some of these luxury brands like China, and some of these emerging markets are major sources of revenue, and that goes for a bunch of these other consumer brands as well. Like, we are in a global economy, so that means you don't just sell to developed markets as well. But yeah, like it's an interesting debate to have for sure, and I've seen people fall on either side of it. I just think they've definitely been a case of you've been waiting for Godot for a long time,
Yeah, yeah.
and part of that's just because of how well the US has done, and whether that situation reverses, maybe it will.
We get to
It's
sort of see.
yeah,
It is a very turbulent time, very
it
confusing
is
time in terms of,
yeah
for the first time, you're just looking at it and you're saying, well, I just don't know what can happen. I have a
yeah
rough idea, but that's again an idea that might occur, might not occur type thing.
yeah.
So again, yeah.
Yeah, no, it's very difficult. So I think the next one we will. Did you want to talk about the Tawny yet, or like
I think
break it
we'll
up?
do one more,
Yeah.
and then
Okay.
we'll get to the
So
second choice of the wines, which
yeah.
is nice. Yes.
All right.
I'm excited.
So
I'm excited.
yeah, I'll just be quick with this one. So some of you might know, like in August, that's when you see a lot of Australian companies report on their sort
yeah.
of financial
Reporting
year,
season.
like how well they did, and also give a bit of an outlook on how well they think they're going to do next financial year. And in that sense, it's important to note not all of the major companies report in this period because some operate on slightly different calendars. So, like a bunch of the major banks aren't going to report till well, September, so October, November, effectively, right? But in terms of what the companies that have reported, how they've done, what they've said, I think at a high level, it's still been positive, but probably not as positive as it was this time last year. For some businesses, you've definitely seen a lot of challenges with inflation, with consumer demand, and also just the broader outlook. So one big thing for a lot of these companies is just a real reluctance to offer guidance. And so what that means is like the company goes out to their investors and says, we reckon we're going to do this much in revenue, this much in profits, and in some cases you're going to get promise a dividend of X cents or dollars.
They've been very shy about guidance because most of them haven't really declared anything. In terms of usually they would.
Yeah, and some that have been especially cagey and been like, oh, I'm in an R and oh, we don't know. Some of those companies have understandably seen their share prices take a bit of a hit just because investors are concerned about how cagey management's been. And you have seen one or two instances where companies were maintaining their guidance coming into reporting season, and then so there's only like 1 month left of operations to cover where they're earning money, and then they come out and disappoint as well. And so when that situation happens, you do tend to see like a big reversal in share prices because people have sort of been bidding the price up because they're confident, and then when it gets dashed, understandably it takes a hit. In terms of broad themes, I guess miners are still making a mozza even with commodity prices off a bit.
Look at BHP's super dividend of over $3.
And they're also getting ready to stretch themselves and buy up. So both Rio and BHP are definitely looking to tap into what they see as the next big trend of like sort of electrification and the transition into renewable energy. So BHP threw in a bid at Oz Minerals because they're cashed up and they want what Oz Minerals is offering in terms of nickel and copper, both metals that are quite crucial to like producing in electric vehicles and also just general industrial use cases with copper.
But even I guess looking at businesses like potash and things like that, that they're trying to create new operations around the world, specifically around Canada and the like. Having been at a conference where the CEO of BHP was presenting, it was really interesting to sort of see that. And it's funny, if you look at this period, you looked at aluminium, the iron ore prices get really hurt, and they're looking, okay, well that's a bit of a reversal, but then coal just made it up for them. It's just interesting to sort of see the dynamics around different commodities, what's working for these companies, what isn't working. I think that global trend of electrification and potentially the move to more and more renewables, especially in the West, especially in Europe, is going to be the real sort of driver. I think if you look at Europe, they're looking at a recessionary environment. Okay,
100%.
Now what usually happens in a very tough period for countries, for peoples, is usually some interesting innovations can come out of it because they're trying to find cheaper and cheaper ways to get or solve the problem they have, which is pretty much, energy. How are they going to solve that whole energy sort of situation with Russia, with prices around that? That's going to be real, I think, cool thing to sort of see in a couple of years' time. So where it all sort of ends up and where it goes. But that's, I guess, where we're at.
And the only other point I'd note, just with how different businesses reported, I think people have been surprised by just how well consumers are still going. So a bunch of these retailers actually did slightly better than expected, and we're still a bit bullish heading into this financial year. And that's interesting, I think, because people are worried. The RBA's hiked rates quite a bit now relative to where they were this time last year. But that being said, households are still spending. We are starting to see a bit of shift though from what you'd call like physical goods, like say furniture, electronics and stuff, to more experiences. So that's like going out, going on a trip, stuff like that. You're definitely seeing a bit of a shift in consumer spending in that regard. So I think one of the big worries, and this is something like we look at for work, right, is just some of these companies have built up like a mountain of inventory because they thought demand was up here and they thought it would continue to stay up here
at much higher levels.
If it's actually down here, then either you have to hold back that inventory or you have to write it down and take a big loss, because ultimately you're saying we can't sell it for what we originally budgeted for. And I think that's why you've seen some businesses in particular struggle a lot, and I think we're going to see more of that. In the States, it's been pretty bad as well in that regard. Some businesses are a lot better at managing that than others, for sure. Right.
And I think that inventory conversation is going to be an interesting one. You've already seen a lot of that. Too much inventory, and then they're just trying to cut down. So in saying that, I think maybe we should move on to the next sort of wine that we've got, which is the Penfolds Grandfather Rare Tawny 20 years aged wine. Probably one of my favourites to have in front of the fire.
Dan's
the best
hoping
for winter.
To become a Penfolds influencer one day.
I love Penfolds, I have to admit. But anyway, no, it just happens to be fitting for this segment. And
just shout out to Penfolds if any of you are watching.
Well, you know what? It is winter, and I did want to have this right now. And the reason is I wanted to have it in my special. I've been waiting for this. My special glasses, my little Tawny glasses. And
apparently, it's a thing. It's not just a gimmick.
It's not a gimmick. It's a thing. And for those listening on the podcast, it is a so if you can look it up. But it's the glass port sippers is what they're called. Glass port sippers. And remember, the cheap ones will break quickly. The ones made with higher quality won't break as much, but they are very delicate. So you must know that. And I did do a glass blowing sort of course, which was interesting. And God, it's hard to make glass or glass items. And looking at this just freaks me out. But anyway, trying it in this and. Wow, it is fantastic. And you know what? It has changed. It's changed since we bought it. It's changed since we've had it. It's gone almost slightly sweeter, which is even nicer.
Mm-hmm. Yeah, no, and that's something any of you listening should know. Like wine, even something fortified like this, which has higher alcohol, higher sugar.
Love it.
The more air you give it, the more it will change. Like. Too much air, look, eventually it's going to turn into vinegar, right? But particularly if you open a bottle and it feels like, oh, I'm not getting any flavour or any aromas from it. Sometimes that can just be the wine's made in sort of a style that deprives it a bit too much of oxygen. And so you want to just leave it open for a bit longer, or even just throw it into like a jug or anything to agitate it and give it exposure to oxygen can really help change the flavour of the wine. Even cheap stuff can definitely improve in a decanter as well.
Oh, 100%. And with this one specifically, so It's a Solera system, so like a cherry or sort of like a multi-vintage sort of approach that they do with this particular Tawny. And there's a number of vintages in that one bottle, so it's obviously aged for 20 years before it's sold. That's why it's known as the great or grandfather type of Tawny, because it's already 20 years aged in an oak cask. So it is very, very enjoyable. There is another version which is a 10-year one. That is also fine if you're not really worried too much or wanting to pay the price point for the 20. But again, it's pretty nice. And there's a little, when you open it comes in this huge, huge box. And when you open it at the bottom there, you'll notice it's with a cork, which you thought was a bit weird. And I was like, well, never fear, Cam. There's a reason why that is the case. It comes with a little glass cork thing that you can use because obviously you can't drink it all in one night.
Unless you've got a big party.
Unless you've got a big party, but you can enjoy it over a few days. So it allows you to do that, and you can just pop it on, and you're all good. And I would highly suggest one of these glass sippers. They are fantastic. Yeah, looks almost like like you're smoking from a pipe. I think that's probably the way to explain it, but it is perfect, and the flavour is really high. Also can get you really drunk really quickly because you don't realise how much you're having.
Yeah, that's why they also tend to give it to you in glasses like this. So if you have it in a glass like this, if that's your goal,
it's all good.
You can probably get cheaper port though if you really wanted to.
Yeah, it's meant to be. You can enjoy it without anything or with some like cheeses or whatnot, but you can just enjoy it on its own. That's I guess the best part of having this Tawny. It's just. It is enjoyable on its own.
Absolutely.
It is the centerpiece, so to speak. It doesn't need anything to go with it. Great. So we've covered that one.
Yep.
We've got two more topics. It's a big one. It's a big one.
Do the inflation one.
Okay, well, I was going to go to the big one, but I think you're right. Inflation targets.
Yeah,
where things have been. I agree. I agree. Inflation. So where things at? It's continuing going. It's going up.
It's starting to reverse though. It's
starting in some places, depending on the place.
It depends how you measure it as well. So when I mean it's starting to fall, it's like if you go by things called. So inflation, you're talking about the price of a basket of goods today versus what it was a year ago or a quarter ago, right? But you can slice that basket in different ways, and what economists will often do is they'll slice it in terms of this is what the overall basket did, and then this is what the basket did if we strip out some of the more volatile components, and those are usually things like oil prices is one. The other one that can be a bit volatile is food as well. Like, we've had it here in Australia. Some of you might remember a few years back, we had cyclones up in North Queensland, so bananas went through the roof, if you could even get them. Yep. And we've had that more recently here with the floods along the east coast, so a lot of fruit and veg has just been...
I don't know if you should be looking at it with it stripped out, given that it's such an important staple. We need to use it. At the end of the day, and I had this conversation internally with my own team, and I was saying, it's great, you strip it out, it's good, it's a metric. We've ignored macro calls for the last 5-10 years, and now all of a sudden they're very important. And then when you look at this and you're just saying, okay, well, let's look at what's sort of occurring here. You need oil prices, and I guess it's going down to the bowser, the cost at the bowser. How do we get to work? Buses, cars, we use petrol on a day-to-day basis to get to jobs and to make the economy continue. If people are finding that difficult to do due to the rising costs, that's obviously going to have an impact overall on the economy. Yeah. And then you look at food. Well, we all need food. It affects us all. Lettuce at what, $10? Yeah. Absolutely ridiculous. I know it's come off right now, but I think you can't strip these things out because it is hurting everyone. Yeah.
But the counterpoint to all of that is, okay, say you can't strip it out, right? Is your solution, because the only tool people ever propose to fight inflation is by increasing interest rates. And that's to me that's like using chemo on cancer, like because what it does is it just makes the cost of borrowing everywhere in the economy a lot more expensive pound for pound, and then you're just like that'll only fix things like the price of lettuce and stuff if you just make everyone a lot poorer, so like there's fewer people that are going after lettuce and prices will adjust. See, I actually think you should strip it to strip it out and try and say, okay, what is this overall basket doing? Is the economy running a bit too hot? And then do we need to use interest rates? And I'd actually say, for me personally, I think a lot of central banks have got it wrong in terms of what they're reacting to. And things like, okay, let's take this point, the price of lettuce and whatever. Okay, we had natural disasters on the East Coast. Is raising interest rates going to magically create more lettuce? No. Is it something that, next season we're going to get a bit more and prices will adjust eventually? Yes. In the meantime, should we have higher rates to fix it? I see. That's one of those cases where I don't think it's really justified.
But the solution.
Yeah, that's the thing. Like, so this is the thing. Inflation comes. What makes prices go higher? Either you have too much demand, right? Or you have supply getting crushed for some reason. So the war in Ukraine, it's deprived a lot of commodities that both Ukraine and Russia produce from the rest of the world. And so if you still want those things, you're going to have to be willing to pay up because there's less supply than there was a year ago. Okay. This is why it's quite tricky. But what I was going to say, just in terms of an overall update, is you are starting to see a few different indicators for inflation show signs of peaking, and so that suggests. And sometimes some of these headline measures have also fallen, like in the US recently. Your core CPI and I think even headline the last reported was. It was a negative surprise, so inflation was actually for the month less than expected for July. So when you look at it in that sense, like arguably you're starting to see increasing signs that inflation across a few regions is peaking. Now the exception to that, one example would be Europe, energy prices. So what you've basically seen these countries faced with is like Russia's kind of, well, not explicitly saying we're cutting you off from gas. They are mucking around with the level of usual supply that they are given to the European countries, and that's once you deprive like a necessary commodity like gas, people have to reach for substitutes, and that just makes the prices of everything related to electricity production just skyrocket, right? The other challenge as well is even the Rhine River is that Germany's going for a bit of a drought situation, so the Rhine is at like quite a low level, and then that has flow-on consequences for was it hydro or uranium, nuclear power, because you can't get as much water to help cool things, and so you have to scale back production and the like as well. So you're having like just this perfect storm of all these things hitting the consumer in Europe. And so really what you're seeing some countries do is they basically turn around and say, we're going to take the hit on the government balance sheet. And so you're going to see a bunch of countries offer subsidies and programs like that. And then you're seeing others that aren't doing that, or at least they haven't been willing to acknowledge it yet. And so the consumers are like, I can't spend their money on anything.
You'll get a situation here, really, when you're looking at it, and I'm just trying to understand it as well. We all are all trying to understand it, put our sort of perspective on it. It's just saying, okay, well, central banks have got it wrong, which I think they had.
Yeah.
But then again, they have a role that they have to play, whether you like it or not. That maybe that's been the issue in terms of, okay, well, there's a role that has to be played. But again, let's go back to the real fundamentals here. Is just looking at it. Well, what do we need? You need ability to get to the place you work to, and ability to put food on the table at a reasonable price, and everything else, comes secondary to that.
Yeah.
I think it's just looking at it, and cost of living is an issue.
Yeah.
The cost in general of obviously on mortgages and the like, obviously a concern. There's just a whole bunch of things. If you looked at it, there was also a conversation around energy. Look at let's say for example in Europe, that they were saying that the average shower or 5 minutes in the shower might cost 10 or 12 euros for every 5 minutes in the shower, which is absolutely ridiculous. And they're going into winter. Again, I just think it's just saying that interest rates will continue to go high to control somewhat of inflationary jumps that we've had.
Yeah.
And they probably might start pushing them back, potentially.
Yeah. And well, that's why, like, if you look at a bunch of, now these are imperfect, but if you look at sort of economist consensus, so like economists as a group putting out forecasts for where they think rates are headed, and for a lot of countries, they're seeing this year as the peak. And then from next year, it's just a question of how much some countries cut rates. And part of that is, one, thinking inflation's peaked, and two, thinking that economic growth's going to take a real hit. And when you talk about what we've just discussed about some of these European countries, like, unless governments really step up, and even then, it'll still be a hit. It's very hard for your economy to grow if all your discretion, like a big chunk of discretionary spending, is just going on a necessity like electricity and heating. Like, if the more that sucks up, the more gets taken away from everything else, and it becomes a lot harder to grow. That's why you have seen increased speculation that we'll see a recession in Europe.
What do we forget?
Next year.
I think recession is probably a call that potentially could affect not just Europe. Potentially, if things continue to go the way they are, if we get a geopolitical sort of tension, another tension that could cause other sort of problems with prices, or the price of oil or whatnot. But then if you look at Jerome Powell's Jackson Hole sort of speech, he quoted over 50 times inflation, and he quoted there could be in a situation where we get longer interest rates at higher levels.
So Dan's talking about the guy that's in charge of the American central bank. So they're the ones that set interest rates for the US economy, and he made headlines recently because he came out with a speech that really pushed back on what some people were saying, that the US was going to be sort of stopping rate hikes or even cutting soon enough. And he came out and said, no, we're focused on inflation, guys. And particularly while the labour market's strong, we're focused on inflation. We're focused on really controlling that, and that led to a sell-off in a bunch of equity markets. So we're hoping the reverse was true.
And after equities in July and for some of August were actually going up.
Massively.
They were thinking, okay, this is it. But obviously he's looking at it and saying, well, it's not the case. And quite frankly, we're getting to a period here where we can potentially have more interest rate hikes, and on top of that, we might have a scenario where, we have higher interest rates for much longer, and that is a concern. That is a major concern. Just a thought.
So how would you wrap this all up? I think. Look, I guess I'll give my 2 cents, and Dan might have a different point of view. For me, I think there are signs that economic growth started to weaken, inflation started to peak. So I think, could there be more pain in terms of interest rates? Sure. Do I think these central banks are going to have to blink at some time over the next year? Also, yes. Like, for me, it's, and look, I might be proven wrong on this. I might underestimate the psychology and how much some of these guys want to make history, but I also don't think these guys want a recession necessarily. So when you see how they're trying to massage some of the numbers, I think even they're aware of some of the risks in place. So I think ultimately, in my opinion, they're going to blink, but it's just a question of when.
I think it's probably going to say, they're not going to say they're going to blink. I think it's going to be, this was all part of the plan. we've got everything under control, or we got it to a level we're comfortable at and it's sustainable and it's controllable, potentially, or I think I'm a little bit more pessimistic in this, that we might actually sort of see they break parts of the economy.
Yeah.
That's probably they've gone too far, because remember, to wind inflation interest rates up, it takes a long time to wind them down, given that even the jumps that they've done have been much higher in terms of almost 100% increases of where the rate was to where it goes. That percentage change.
But it's not just that, it's what rates get locked in. So in the US, right, compared to how our mortgage market works, there you get offered a 30-year fixed rate for your mortgage. You don't get offered variable typically as an option. So when rates materially move higher, most people can't afford, well, you've got fewer people that can afford this higher fixed rate for the next 30 years. And so, funnily enough, the US housing market just grinds to a halt when that happens. And you've seen that, like new home sales, new home starts, and that are cratering over there right now. And any business that's linked to the housing industry has seen their share price correct. And some of the companies I've seen, it's like 40-50%. Even a James Hardie here or a CSR as well, they've both seen a pretty big hit from where they were previously. So it's going to be a tough recipe, that's for sure.
That's for sure.
And I guess the last topic?
Yes, we'll just quickly on mortgages.
What you do.
Fixed, variable, like this leads into this sort of really important sort of space. You might want to start this one.
Okay, sure. Yeah, so we're having this debate.
Because we're literally going back and forth with this one.
Yeah, so we're having this debate in the office, actually. And really, it's actually interesting if you look back over the history, what's been the optimal thing to do. And basically, outside of one or two periods, like the two rates tend to trade fairly closely to another. It's only more recently that you've seen fixed rates as the RBA had this emergency funding program they deployed during COVID that basically it sort of underpinned the banks and made it so that they were able to offer very low fixed rates to all of us, but still make a meaningful profit because the RBA was willing to give them a pile of money at a below market rate, effectively. That's gone now. So what you're starting to see is there were a bunch of people that took up those fixed rates, and now they're starting to roll off. And the question really is like, what do you do now? Like, do you fix some of it? Do you go variable? And to be honest, when I look at where fixed rates are at now, just on average across like the major banks and even some of the non-banks, for me personally, I just have a really tough time to justify fixing right now. I think like on balance, rates are more likely to, even if they go up a bit more, I think in the near term they're more likely to start going down. And so I think it's really tough to justify fixing, particularly for a longer term like 3 years. I think fixing does offer you a level of certainty, but it's also, you have to think about the premium of the fixed rate relative to where variables are sitting now. Yeah. And you've got to see, RBA rate hikes and sort of market movement to justify it.
Having looked at this recently, to be honest, for those who fixed it probably 6 months ago, you're laughing. Yeah. For that 1 year, 2 years, that's fine. It will roll off. It'll probably roll off in a period where it'll probably be quite helpful. Now, in saying that, fixing it, even they've moved so much, as you said, fixing it now to a level where it's probably even higher than what the variable rate is, it's probably not worth it. But again, your own circumstances will really determine that. You might get a sweet deal. If that's the case, great. If it isn't, I don't know. From myself personally, I've just left it at that variable sort of position. But anyway.
Yeah, and I think that's about it. But look, there will come a time where the premium definitely contracts, and and you have had cases in the past where fixed was below variable, and in those circumstances, you can potentially hedge your bets and just go 50-50, right?
Correct.
Particularly when you get in on favourable terms. The state of the market is as it is right now. It's really hard to justify locking yourself in for that kind of period.
Agreed. Now on the last part, which is the wines, rating the wines. What are we thinking for the yellow, the wine of your choosing?
It's a tough one for me because I don't hate it, but I don't necessarily love it heaps either. So I'm kind of in and ahhing.
Right. So it's not really a must-have.
I don't think so. I think
a hold, or
I think. Look, it'd still be interesting. And maybe a friend or someone else can have a bottle and crack it open, and I'll be pleasantly surprised 5 years from now. It's just we might have actually opened it too early. I think there's a few unknowns, but as it is right now, would I necessarily go back and repurchase it? Because particularly knowing that this style does not come cheap either. It's probably a no from me. I have had other wines in this style that are more expensive, that are nice, but even then it's really hard to justify the pricing, I think, personally.
I think from my perspective at the start I wasn't a big fan. I'll say it right now. Towards the end I started to become a fan, but probably not something I would go out of my way.
No,
if it was an occasion and it happened to be there, I think I'd really enjoy it.
Yeah.
I think I really would.
But again, would you want a place for if you had limited space to store wines, would you actually want to give up something
probably
for
not.
This style?
Probably not. For the Tawny, for the Tawny, I say I give it the highest rating. But I love it. It's my winter wine. I always have it each winter, and I love having it in my sippers. My sipper glasses, sipper port glasses, and quite frankly, it's always fun. Everyone has a good laugh.
Yeah.
I think they continue to laugh after that because they're probably drunk. It's great. It's absolutely great. So I don't know. Obviously, that was my suggestion.
Look, it is a lovely Tawny. I think relative to the ones I've tried before, there's probably one or two other examples I'd prefer over this, because I found. For me,
he's not a sweet tooth.
Yeah, I still find it probably erring on the side of a little bit too sweet for
I love
me.
it.
And look, I was lucky enough the other day to try a fortified added Heathcote, and that Heathcote in Victoria, and I think that one probably had the better balance, had a bit of spice, and it had the better balance in terms of less sweetness, which I think actually adds to drinkability for me. So I'd still give it a good rating. Look, if you gave me a glass of this, I'm not going to say no. But
so it's a yes. It's a buy. It's buy. 100%.
For you.
No, we got it.
My problem is I just don't drink fortifieds that often. I forget I have them.
Only for winter.
Yeah, but I forget I have them.
I forget, and then they're even better when you open them. Because
instead of
20 years, it's 30 years.
Yeah, well, that's the other thing to note. As long as you don't store it in a shed where it's exposed to high temperatures, the fortifieds will last forever.
Yeah.
They've enough sugar and alcohol. They're natural preservatives.
Awesome. So, lovely. So thanks everyone for joining us in this session today. I think the next session we might have a guest speaker potentially. That's
good to me.
Yeah, we'll circle back, but there's going to be an interesting topic that we've got planned. So thank you for joining us for today's one, and again, we'll see you very, very soon. See ya.